Have you ever felt it? That subtle tremor of unease, the prickle on the back of your neck when something feels fundamentally wrong. It's a feeling most of us dismiss, a fleeting anxiety about the news, a worry about bills. But what if that feeling isn't a personal failing, but a primal instinct, a warning signal? What if, deep down, you sense that the foundations of the world as you know it are shifting? We've been told a story, a carefully constructed narrative about prosperity, stability, and the unwavering strength of our financial systems. A story where hard work guarantees success and savings secure your future. But what if that story is a carefully crafted illusion? What if the very institutions designed to protect you are, in reality, protecting something else entirely? I'm Graham, and I want to talk to you about something critical. Something that could profoundly impact your financial future and your peace of mind. This isn't about quick schemes or get-rich-fast promises. It's about understanding the forces at play, the hidden currents swirling beneath the surface of our global economy. It's about recognizing that the rules are changing and knowing how to navigate the new reality. For generations, we've placed our trust in a system built on faith in governments, faith in banks, and most importantly, faith in the dollar. But faith, as it turns out, is a remarkably fragile foundation. The history of money is a graveyard of collapsed currencies, of empires built on promises that couldn't be kept. And right now, the warning signs are flashing brighter than ever. Imagine a delicate mobile, perfectly balanced, each element representing a piece of the global economy. Now imagine someone subtly, persistently, adding weight to one side. Slowly, almost imperceptibly, the balance shifts. That's what's happening right now. The weight of debt, the erosion of trust, the geopolitical instability, it's all tilting the scales. And in the midst of this uncertainty, one asset is quietly, steadily rising. One ancient store of value is reasserting its timeless appeal. That asset is gold. Not the glittering jewelry of royalty, but the fundamental, elemental metal that has served as a beacon of stability for millennia. Think about it. For thousands of years before fiat currencies, before central banks, before even the concept of nations, gold was money. It wasn't decreed valuable, it is valuable. Its rarity, its durability, its inherent beauty, these aren't arbitrary qualities. They're fundamental properties that have resonated with humanity for centuries. It doesn't rely on promises, it relies on existence. But to understand why gold is surging now, we need to rewind. We need to understand how we arrived at this precarious moment in history. Our story begins in 1792 with the birth of the United States and the Coinage Act. This act established a standardized monetary system based on gold and silver. For decades, this system functioned remarkably well. It provided a sense of stability and predictability, fostering trade and economic growth. Other nations followed suit, adopting the gold standard, creating a global network of commerce anchored by this precious metal. Imagine a world where your currency could be redeemed for a fixed amount of gold. A world where governments couldn't simply print money at will. It sounds almost utopian, doesn't it? It was a system of checks and balances, a constraint on unchecked power. But constraints, as history has shown us, are often inconvenient for those in power. The first cracks began to appear during the Great Depression. As the economy spiraled downwards, people lost faith in banks and in the promises of governments. They began to demand their gold. A run on the banks ensued, threatening to collapse the entire financial system. In 1933, President Franklin D. Roosevelt took a drastic step. He issued Executive Order 6102, effectively banning private ownership of gold. Think about the audacity of that act, forcing citizens to surrender their legally owned property to the government. It was a seismic shift in the relationship between the state and its people. And it was justified, of course, by the need to save the banking system. The narrative was control and fear. The U.S. government amassed the largest gold reserves in the world. And after World War II, a new system emerged, Bretton Woods. Under Bretton Woods, the U.S. dollar became the world's reserve currency, pegged to gold. Other nations tied their currencies to the dollar, creating a global monetary order centered on American economic power. For a time, this system worked. But the seeds of its destruction were sown in the escalating costs of the Vietnam War and the ambitious social programs of the 1960s. The U.S. began to spend more than it earned, accumulating debt and stretching its gold reserves to the breaking point. In 1971, President Richard Nixon made a fateful decision. He severed the dollar's link to gold. This was a pivotal moment. The gold standard was officially abandoned. The dollar became a fiat currency, its value based not on a tangible asset, but on the full faith and credit of the U.S. government. In simpler terms, its value was based on trust and the ability of the government to manage the economy. What followed was a period of unprecedented monetary expansion. Governments around the world gained the ability to print money with abandon, fueling economic growth, but also sowing the seeds of inflation and instability. The price of gold, freed from its artificial constraints, soared. From $35 an ounce in 1970 to $594 in 1980, a staggering increase. Adjusting for inflation, that's equivalent to over $2,400 today. But for the next 3 decades, gold's performance was muted. The dollar remained the dominant global currency, and economic growth seemed to quell concerns about inflation. Many dismissed gold as a relic of the past, a barbarous relic, as one famous economist called it. But the underlying dynamics hadn't changed. The ability to print money without restraint remained, and the debt continued to mount. Over the last few years, we've witnessed a confluence of factors that are driving investors back to gold. Inflation, triggered by pandemic-era stimulus and supply chain disruptions, is eroding the purchasing power of fiat currencies. Geopolitical tensions, from the war in Ukraine to the conflicts in the Middle East, are creating uncertainty and fear. And the growing realization that the U.S. dollar's dominance may be waning is prompting countries to seek alternatives. China, Russia, and other nations are actively reducing their reliance on the dollar, exploring alternative trading arrangements, and developing their own digital currencies. This isn't a sudden shift, but a gradual process, a tectonic movement in the global financial landscape. And it's accelerating. Now let's talk numbers. Gold has outperformed U.S. bonds, commodities, and even global stocks over the past 20 years. Over the last decade, it's delivered an annualized return of 8.3%. And during times of economic unrest, It's consistently proven to be a safe haven, preserving wealth while other assets plummet. During Black Monday in 1987, when stocks crashed 30%, gold barely moved. During the dot-com bubble burst in 2000, gold fell only 12% compared to a 44% decline in the S&P 500. And during the COVID crisis in 2020, while markets plunged 20%, gold dropped by a mere 0.86%. Gold is also one of the most liquid assets in the world, second only to the S&P 500 in terms of trading volume. This means you can buy or sell it quickly and easily at any time. But here's where things get interesting. Gold isn't always the inverse of the stock market. It doesn't simply go up when everything else goes down. The correlation between stocks and gold is surprisingly low over the long term. In fact, there have been periods where both stocks and gold have rallied simultaneously, like in the 1980s, the 2010s, and the 2020s. So what does the future hold? What could drive gold prices even higher? Analysts are offering a range of predictions. Billionaire investor Jeffrey Gundlach believes we could see $4,000 an ounce. Goldman Sachs is forecasting $4,500 in a more extreme scenario. And Rob McEwen, a mining magnate, even suggests $5,000 is within reach. These projections are based on a number of factors, including continued inflation, escalating geopolitical tensions, a weakening dollar, and increasing demand from central banks. But here's the crucial point. The price of gold is ultimately determined by fear. The more people fear economic collapse, currency devaluation, and the loss of confidence in the financial system, the higher gold will climb. And right now, fear is abundant. We're witnessing a growing crisis of confidence in our institutions. The recent turmoil in the banking sector, the ongoing debt ceiling debates, the political polarization, it's all contributing to a sense of unease. Even the chairman of the Federal Reserve, Jerome Powell, is facing unprecedented scrutiny and calls for his removal. China is flexing its economic and military muscle, and the global order is becoming increasingly fragmented. This is not a time for complacency. It's a time for prudence, for diversification, and for protecting your wealth. But before you rush out to buy gold, let's address a critical question. Is it too late? Have we missed the boat? The answer, as always, is it depends. It depends on your investment horizon, your risk tolerance, and your overall financial goals. Gold is not a get-rich-quick scheme. It's a long-term store of value, a hedge against systemic risk. It's not about making a fortune overnight. It's about preserving your wealth over time. And here's a crucial concept: the gold to S&P 500 ratio. This ratio tells us how many ounces of gold it takes to purchase the S&P 500 index. When the ratio is high, stocks are relatively cheap compared to gold. When the ratio is low, gold is relatively cheap compared to stocks. Historically, when the ratio reaches extreme lows, it's often a good time to buy stocks. And when it reaches extreme highs, it's often a good time to buy gold. Now, I'm not a financial advisor, and this isn't financial advice. But understanding this ratio can provide valuable insights into the relative valuations of these two asset classes. My own portfolio reflects a diversified approach. I hold a mix of cash, treasuries, U.S. stocks, international stocks, real estate, and a Bitcoin ETF. I believe in spreading my risk across different asset classes and adapting my strategy to changing market conditions. And yes, I have an allocation to gold. Not a large allocation, but a meaningful one. I see it as insurance, a hedge against the unforeseen. Because let's be honest, the future is uncertain. We don't know what tomorrow will bring. But we can prepare. We can protect ourselves. So what's my final take? I believe gold will continue to play an important role in the global financial system. I believe it will continue to serve as a safe haven during times of crisis. And I believe it has the potential to appreciate in value over the long term. But I don't see it as a replacement for a well-diversified investment strategy. Don't put all your eggs in one basket. Don't chase the latest hot trend. Do your research, understand your risk tolerance, and make informed decisions. And remember, the most important investment you can make is in yourself, in your knowledge, your skills, and your financial literacy. Before I wrap up, I want to talk about something else that's just as important as protecting your financial assets, protecting your personal data. In today's digital world, your information is a valuable commodity. It's being collected, sold, and used in ways you may not even realize. Every time you sign up for a product or service, every time you make a purchase online, your data is being tracked and analyzed. This leads to spam calls, phishing emails, and the constant threat of identity theft. It's a scary reality, but thankfully, you have the right to protect your privacy. You can request that data brokers remove your information from their databases. But this is a tedious and time-consuming process. That's where our sponsor, Cogni, comes in. Cogni automates the entire process for you. They reach out to data brokers on your behalf, requesting that your personal data be removed. They handle any objections and ensure that your information stays off the market. And because data brokers are constantly collecting new information, Cogni continuously monitors and removes your data, keeping you protected. They offer a risk-free 30-day trial, so you can try it out and see the results for yourself. To learn more and get 60% off an annual plan, visit cogni.com/Graham and use the code Graham at checkout. The link is also in the description below. Protecting your financial future and your personal data are both essential. Don't wait until it's too late. Take action now. Now back to gold. Remember that the price of gold is ultimately driven by sentiment, by fear, and by the perception of risk. The higher the price climbs, the more attractive stocks may become. And the more confident investors become in the future, the less appealing gold may seem. It's a cyclical process, a constant ebb and flow. Don't get caught up in the hype. Don't let fear drive your decisions. Stay informed, stay rational, and stay diversified. And remember, the long-term success of your portfolio depends not on timing the market, but on time in the market. I hope this video has given you some food for thought. I want to encourage you to do your own research, to challenge your assumptions, and to make informed decisions about your financial future. The world is changing rapidly, and it's up to each of us to adapt and thrive. If you agree with my assessment, or if you have a different perspective, please share your thoughts in the comments below. I always appreciate hearing from you. And if you found this video helpful, please like and subscribe. It means a lot to me, and it helps me continue to create content like this. Thank you so much for watching, and until next time, stay vigilant, stay informed, and stay prepared.